The bond market is in control, not the Federal. That is the warning investor Peter Boockvar, the 𝗗𝗜𝗦𝗖𝗢𝗗𝗘 Wealth Partners CEO, just gave in a recent CNBC interview, and it could completely change how you think about this market. In this video, I'm going to show you the clip, break down exactly what he meant, and give you my take on why this matters right now. Then I'll walk you through 3 stocks I believe are built to survive and thrive in this kind of environment. Let's hear what Peter Boockvar had to say.
Peter Boockvar, Chief Investment Officer at BFG Wealth Partners. Let's go back now to the markets, Peter. You got a 10-year at 4.42%. To Guy's point, to Tim's point, we're looking at Japan and their move, because our bond market is not the only one that is moving around the world. I want to highlight that. In fact, in some cases, other bond markets are moving a lot more aggressively. How much is that impacting the trade for stocks right now?
I think it's definitely part of the equation. And also you have jumping yields in Europe. You have the UK 10-year gilt yield, which closed above 5%. So it is a developed market global bond sell-off. And it's not just worries about inflation. Even before this, there were growing concerns about debts and deficits. And what we're seeing now is only going to enhance that, whether it's government spending on consumer subsidies to try to temper the impact of the energy crisis that's going on, whether it's going to be a huge ramp up of defense spending. There's, again, a major rethink, an investor desire to take duration risk. And the ripple effects are wide. We know we have a very over-levered global economy, particularly on the sovereign level, but also at that corporate level. Going into the war, we were worried about private credit. Well, all these portfolio companies that were hoping for lower interest expense because of the cut in the Fed funds rate, well, that has disappeared. So funding costs going up affects everything.
So, Peter, when you look at it, I look at it through a different prism. Extend out for me, and I'm finding that I still keep circling back to lower rates. Now, the bond market's doing what the bond market does around the Fed, so it's not reliant on that. But when you fast forward, I do believe we're going to get back to a rate-cutting environment for a couple of reasons. A, if we slip into a recession, they're going to cut rates. B, if Powell moves from that seat, they're going to cut rates. And C, if they try to make the mistake, which I think is a mistake, of raising rates into a supply shock of oil, they're going to wind up pushing us into a recession, and that winds up into a rate-cutting cycle. Just comment on that for me.
Well, a couple of things. The Fed's cut 175 basis points, and the 10-year yield is higher than it was in the summer leading into those initial cuts in September 2024. So even if they cut, doesn't mean that the rest of the curve is going to accommodate that. If the 10-year yield doesn't think that the Fed should be cutting because of inflation and we said debts and deficits, well, the Fed may cut the short-term Fed funds rate to call it 3, but the 10-year yield may go to 5. Are we better off? Well, depending on where in the yield curve you're borrowing, will determine that. So I don't just think that Fed rate cuts are going to solve the whole curve. And one key thing here, if the Fed, the pain point in the economy is inflation. Companies right now are limiting their hiring because they're trying to cut costs. They're trying to preserve profit margins. So if the Fed starts to cut in response to that weakening hiring, are companies all of a sudden going to hire again? No, they're focused on cutting costs right now. So if inflation is the main pain point, which I believe, that I think should be their main priority, even if the economy slows down, because I don't know what rate cuts are going to cure.
Well, also, I will remind our audience, helpfully, I'm sure that, Peter, that the Federal Reserve cut rates by 0.5%, kind of a shock 0.5% cut in September or whatever of 2024, when inflation was pretty much exactly the same as it is now, although we know inflation is going to go up because of the price of oil. I just want to throw that out there. What is the bond market seeing that the Federal Reserve is not communicating? Because the Federal Reserve hasn't said we're going to raise rates, right? There's still talk of potential rate cuts, and the bond market is pulling a honey badger in that it doesn't seem to care.
Because I think the bond market is complicating central bank decision making, because if I'm right, that debts and deficits do matter, well, then just analyzing the longer end of the yield curve is not just a growth and inflation thing. It is, do we want to lend money to these over-levered governments? Yeah, maybe they'll pay me back because they can print the money, but if they're going to do it in degraded currency, well, then why do I want to own long-term bonds? So I think that is a major thing here. And I say that because we're seeing the same bond market reaction in all the many over-levered countries like Japan, like the UK, like France, and growingly like Germany, whose debt to GDP ratio has quickly jumped from about 60% to 80%.
First off, the conversation opens with something a lot of people are overlooking, and that's the global bond market. Not just the US, not just the Fed, but what's happening across Europe, the UK, Japan. And Boockvar immediately points out something critical. This is not a localized issue. This is a global bond sell-off. And that right there is the first big takeaway. Because most investors, especially retail investors, are still thinking in terms of what is the Fed going to do? But the bond market is telling you something bigger is happening. When yields are rising across multiple developed economies at the same time, that is not just about inflation. That is about trust. Trust in governments, trust in fiscal policy, and ultimately trust in the value of money itself. And personally, this is where I actually agree with Boockvar. I think the market is starting to price in something people don't want to admit yet. Governments around the world are too deep in debt, and the era of cheap money has consequences. He talks about deficits, government spending, energy subsidies, defense spending, and all of this adds up to one thing: more borrowing. And when there is more borrowing, investors demand higher yields to compensate for that risk. Now here's where it gets really interesting. He introduces this idea of duration risk, which basically means investors are becoming less willing to lock up their money in long-term bonds. And if you think about it, it makes perfect sense. Why would you lend money for 10 years at a fixed rate if inflation is uncertain and governments are printing more money? That hesitation is what's pushing long-term yields higher. And this is where the ripple effect starts. Because rising yields don't just affect bonds. They affect everything: stocks, real estate, corporate borrowing, private credit. And he makes a really strong point about private credit specifically. A lot of companies were expecting lower interest costs if rates came down. But now that expectation is gone. Instead, their funding costs are rising. So now you have a situation where companies are squeezed. Higher borrowing costs, pressure on margins, and uncertainty about demand. And that leads into the next major part of the conversation, which is the debate about rate cuts. One of the hosts suggests that eventually we're going back to lower rates. Maybe because of a recession, maybe because of leadership changes at the Fed, maybe because of policy mistakes. And this is where Boockvar pushes back hard. He basically says, even if the Fed cuts rates, it doesn't mean it will fix the problem. And this is such an important point that I think most people miss. The Fed controls short-term rates, but the bond market controls long-term rates. And he gives a perfect example. The Fed already cut rates by 175 basis points, yet the 10-year yield is still higher than it was before those cuts. So what does that tell you? It tells you the market does not fully believe in those rate cuts. Or at least, it doesn't believe they solve the underlying issues. And in my opinion, this is where things start to get uncomfortable for investors. Because we've been conditioned to think that whenever the Fed cuts rates, everything goes up. Stocks go up, borrowing gets cheaper, growth comes back. But what Boockvar is saying is that this time might be different. If inflation remains a problem, and if deficits keep growing, the bond market might actually push long-term rates higher even as the Fed cuts. So imagine that scenario for a second. The Fed cuts rates, but mortgage rates stay high. Corporate borrowing stays expensive. The cost of capital doesn't really come down. That is not the environment most investors are prepared for. Then he goes even deeper into the real economy. He talks about hiring. Companies are not slowing hiring just because rates are high. They are doing it because they are trying to protect margins. They are cutting costs. So even if the Fed cuts rates, companies are not suddenly going to start hiring again. That behavior doesn't flip overnight. And I think this is a very realistic view. Because businesses don't operate based on Fed announcements alone. They operate based on profitability, demand, and risk. If they are uncertain, they stay cautious. Now the final part of this interview is probably the most important. He talks about the bond market complicating central bank decisions. And this is where things get almost philosophical. He says that the bond market is no longer just reacting to growth and inflation. It is reacting to debt levels and fiscal sustainability. In other words, investors are asking a very simple question. Do I actually want to lend money to these governments long-term? And yes, governments can print money. But if they pay you back in weaker currency, you still lose. So investors demand higher yields as compensation. And that is exactly what we are seeing. Not just in the US, but in Japan, in the UK, in Europe. So this is not a one-country problem. This is a global shift in how capital is being priced. And if I'm being honest, this is the part that I think is the biggest long-term story here. Because once the market starts questioning sovereign debt at scale, that changes everything. It changes how stocks are valued, how currencies behave, how capital flows across borders. And I don't think we are fully there yet, but this interview suggests we are moving in that direction. So if I had to sum up Boockvar's entire argument in simple terms, it would be this. The bond market is in control right now. Not the federal rate cuts are not a magic solution. And the real risk is not just inflation, but the growing weight of global debt. And personally, I think investors need to start paying a lot more attention to this. Because if the bond market keeps pushing back against central banks, we could be entering a completely different kind of market cycle than what we've been used to over the past decade. And that is where the real opportunity and the real risk are going to come from. If this resonates with you, you're exactly who this channel is for. People who are ready to stop losing money in the market and take their investment portfolio to the next level. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's dive into the 3 lucrative stocks to buy and hold forever. The first stock is Carvana, ticker symbol CVNA. Now to really understand Carvana, you have to zoom out and look at the industry it is operating in. The used car market is one of the largest retail markets in the world, but it is also one of the least efficient. It is fragmented, it is inconsistent, and it is filled with friction at every level. You have thousands of dealerships, each with different pricing models, different inventory quality, and different customer experiences. And on top of that, the buying process itself is broken. Negotiations, paperwork, financing pressure, time spent physically visiting locations, and a lack of transparency around pricing and vehicle condition. This is not a modern system. And whenever you have a large market operating on an outdated system, there is an opportunity for disruption. Carvana's entire thesis is built on that idea. Instead of improving the dealership model, it removes it entirely. It replaces it with a fully digital platform where every part of the process is streamlined. Customers can search inventory across a wide selection of vehicles, see transparent pricing, get financing instantly, and complete the purchase without ever stepping into a dealership. That is not just convenience. That is a structural shift in how the transaction happens. Now here is where most people stop their analysis. They say, okay, Carvana is an online car seller. But that is not where the real value is. The real value is in how the business is structured underneath. Carvana is vertically integrated. It sources vehicles. It reconditions them through its inspection centers. It manages logistics and delivery. And it provides financing. Each of these layers is important because each layer gives Carvana more control over the experience and more opportunities to capture margin. For example, reconditioning allows them to standardize quality. Logistics allows them to scale nationally. And financing allows them to generate additional revenue per transaction. This is not just a marketplace. It is a system. Now let's talk about what went wrong. Because this is where the story becomes more interesting. Carvana grew aggressively during a period of low interest rates and strong demand. It expanded its infrastructure, increased inventory, and took on debt to support that growth. Then the macro environment changed. Interest rates rose. Financing became more expensive. Consumer demand weakened. And suddenly, the model that worked in a low-rate environment was under pressure. The market reacted quickly. The stock collapsed. And many investors assumed the business was fundamentally broken. But here is what separates short-term narratives from long-term opportunities. Carvana did not disappear. It adapted. According to the article, the company made significant operational changes to stabilize the business. It focused on reducing costs. It improved efficiency across its operations. And most importantly, it worked on improving its unit economics. Now let's pause on that for a second. Unit economics is one of the most important metrics for any business. It tells you whether the company makes money on each transaction. If your unit economics are strong, you can scale profitably. If they are weak, growth only increases losses. Carvana recognized this and shifted its focus. Instead of chasing growth at all costs, it focused on making each sale more profitable. That is a major shift in strategy, and it is exactly what the business needed. The article highlights that Carvana has made meaningful progress toward profitability. And this is the turning point. Because once a company proves it can generate profit, the entire narrative changes. Now let's talk about the long-term opportunity. The used car market is still massive, and Carvana's market share is still relatively small. which means there is significant room to grow. But growth is not just about selling more cars. It is about doing it efficiently. If Carvana can continue improving its margins while expanding its reach, it can become a very powerful business over time. Now here is my personal take. Carvana is one of the most misunderstood stocks in the market right now. Most people either see it as a failed growth story or a risky turnaround. But what they are missing is the structural advantage of the model. If the company can execute properly, it is not just competing with dealerships. It is replacing them. And replacing an outdated system is where real value is created. But I want to be clear. This is not a low-risk investment. Carvana still has challenges. It is sensitive to interest rates. It relies on financing. And it still needs to prove consistency in profitability. But that is exactly why the opportunity exists. Because the market has not fully priced in a successful turnaround. And if that turnaround continues, the upside could be substantial. Now let's move to the second company, NVIDIA, ticker symbol NVDA. This is where we shift from turnaround potential to pure dominance. Because NVIDIA is not just participating in a growing market. It is defining the infrastructure of one of the most important technological shifts in decades. Artificial intelligence is not just a trend. It is becoming the foundation of how software is built, how businesses operate, and how data is processed. And at the center of that transformation is compute power. Massive, scalable, high-performance compute power. That is what enables AI models to be trained. That is what allows them to run efficiently. And that is where NVIDIA comes in. Its GPUs have become the standard for AI workloads. But to really understand NVIDIA's advantage, you have to look beyond the hardware. Because NVIDIA is not just selling chips. It is building an ecosystem. Developers build their models using NVIDIA's software tools. Companies optimize their infrastructure around NVIDIA's architecture. And once that ecosystem is in place, switching becomes difficult. This is what creates a moat. Now let's go deeper into the numbers and growth drivers mentioned in the article. NVIDIA has experienced explosive revenue growth driven primarily by demand for data center infrastructure. This is where the real money is. Data centers are expanding rapidly as companies invest in AI capabilities. And NVIDIA is supplying the hardware that powers those systems. But here is something even more important. This demand is not coming from a single source. It is coming from multiple industries. Technology companies, enterprise software providers, cloud infrastructure platforms, all investing heavily in AI, and all requiring more compute power. This creates a broad and diversified demand base. Now let's talk about margins. NVIDIA operates with high margins, which is a key indicator of a strong business. High margins mean the company can generate significant profit from its revenue. And that gives it flexibility. It can invest in research. It can expand its capabilities. And it can maintain its competitive position. Now here is where I want to add my perspective. NVIDIA is one of the few companies that benefits from both growth and necessity. Growth because AI demand is increasing. Necessity because that demand cannot be fulfilled without compute power. That combination is extremely powerful. But there is also a challenge. The market knows this, which means expectations are high. And when expectations are high, the company has to continue delivering strong results. If it does, the stock can continue to perform. If it does not, the stock can become volatile. So this is not just about buying and holding blindly. It is about understanding the business and the cycle it operates in. When people think about NVIDIA, they often think about GPUs as products. But NVIDIA is not really a product company anymore. It is a platform. And platform companies are fundamentally different. A product can be replaced. A platform becomes embedded. Once developers, enterprises, and entire industries build on top of a platform, it becomes extremely difficult to move away from it. And that is exactly what NVIDIA has built. Its CUDA software ecosystem is one of the most important assets the company has. It allows developers to program GPUs efficiently. It provides tools, libraries, and frameworks that make building AI applications easier. And over time, this ecosystem has created a form of lock-in. Because when your entire system is built around NVIDIA's architecture, switching to another provider is not just about changing hardware. It requires rewriting code, retraining systems, and rebuilding workflows. That is expensive. That is time-consuming. And that is why most companies stay. Now let's connect this back to the long-term opportunity. The article highlights NVIDIA's explosive growth driven by AI and data center demand. But what matters more than the growth itself is the durability of that growth. And this is where NVIDIA stands out. AI is not a one-time investment. It is an ongoing process. Models need to be trained. They need to be updated. They need to be scaled. And all of that requires continuous compute power, which means continuous demand. This is not a spike. This is a cycle, and NVIDIA is positioned right in the middle of it. Now here is another important layer. NVIDIA is not just selling to one type of customer. Its demand is coming from multiple sources. Cloud providers building infrastructure, enterprises integrating AI into their operations, startups developing new applications, and even governments investing in AI capabilities. This diversification matters because it reduces dependency on any single customer or industry. Now let's talk about the financial strength again, but from a deeper perspective. High margins are not just about profitability. They are about control. When a company has high margins, it has room to invest. It can spend more on research and development. It can innovate faster, and it can maintain its leadership position. This is how dominant companies stay dominant. They reinvest their profits to stay ahead. Now let me give you my personal view on NVIDIA as a long-term investment. This is one of those companies that you do not overcomplicate. It sits at the center of a massive shift. It has a strong competitive advantage, and it is executing well. The main question is not whether the business is strong. The main question is how long the current growth cycle can continue, because that will determine how the stock performs over time. But from a business perspective, NVIDIA has all the characteristics of a long-term compounder. Now, before we move to the third and final stock, I want to quickly share something with you. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move to the third and final company, Ferrari NV, ticker symbol REC. And this is where the conversation shifts from technology and disruption to something much more timeless. Brand power. Ferrari is one of the clearest examples of how a company can turn brand into a long-term economic advantage. But to understand Ferrari, you have to think differently. Because this is not a company trying to sell as many cars as possible. It is a company trying to maintain exclusivity. And that is a completely different strategy. Most businesses grow by increasing volume. Ferrari grows by controlling volume. It deliberately limits how many cars it produces. And by doing that, it ensures that demand always exceeds supply. This creates scarcity, and scarcity creates pricing power. Now let's break that down. When a company has pricing power, it can increase prices without losing customers. That is one of the most valuable traits a business can have, because it allows the company to grow revenue without relying solely on selling more units. Ferrari continues to demonstrate this strength through strong revenue growth and industry-leading margins. But here is where it gets even more interesting. Ferrari's customers are not price-sensitive in the same way as typical consumers. They are buying into a brand. They are buying status. They are buying exclusivity. And that makes the business more resilient, because demand does not disappear as easily during economic downturns. Now let's talk about margins. Ferrari operates with some of the highest margins in the automotive industry. And that is not by accident. It is the result of its strategy. By limiting supply and maintaining brand prestige, Ferrari can charge premium prices. And those premium prices translate into strong profitability. Now let me give you my perspective on Ferrari. This is one of the most predictable businesses in the market. It does not rely on rapid growth. It does not depend on technological breakthroughs. It relies on consistency. And consistency is powerful, because over time, consistent performance compounds. Now let's look at growth drivers. Ferrari continues to introduce new models. It offers extensive customization options, and it expands its brand into new areas. All of these contribute to revenue growth without compromising exclusivity. This is a delicate balance, but Ferrari has managed to maintain it. Now here is something that I think a lot of investors overlook. Ferrari is not just an automotive company. It is a luxury brand, and luxury brands operate under different rules. They focus on perception, they focus on experience, and they focus on maintaining their image. And that creates a different type of business model, one that is less sensitive to economic cycles and more focused on long-term brand value. Now let's step back and connect everything. Carvana represents transformation, a company trying to modernize a large and inefficient market. NVIDIA represents infrastructure, a company powering one of the most important technological shifts in decades. Ferrari represents control, a company that has mastered its brand and pricing power. 3 different models, 3 different advantages. And this is where things get interesting for investors. because owning all three gives you exposure to different types of value creation. Now here is something I want you to think about. Most investors look for certainty. They want to know exactly what will happen. But the market does not work that way. What you can do is identify strong businesses with durable advantages, and then position yourself to benefit from their long-term growth. Now here is where everything comes together. Because identifying great companies is only one part of the equation. The real advantage comes from understanding how to hold them. And this is where most investors get it wrong. They find strong businesses, but they do not give those businesses enough time to work. When you look at 𝗗𝗧, you are looking at a company that is still proving itself. This is not the most stable business on this list, but it is the one with the most potential for upside if execution continues. It is rebuilding trust with the market. It is improving its fundamentals. And it is operating in a massive market that is still far from being fully digitized. This is the type of investment where conviction matters. Because there will be volatility. There will be moments where the stock moves sharply. But if the underlying business continues to improve, that volatility becomes part of the opportunity. Now, when you look at NVIDIA, you are looking at a company that is already dominant. This is not about proving the model. The model is already proven. This is about sustaining leadership. And the key question becomes how long the current demand cycle can continue. Because as long as AI continues to expand, NVIDIA remains at the center of that growth. This is the type of company that can continue compounding, but it requires awareness. You have to understand the expectations built into the stock. You have to understand that periods of rapid growth can be followed by periods of consolidation. But over the long term, the business itself remains strong. Now, when you look at Ferrari NV, you are looking at consistency. This is not a company that depends on market cycles to perform. It is not driven by hype. It is driven by discipline. It controls its production. It controls its brand. And it maintains its pricing power. This is the type of company that compounds quietly. It may not attract the same attention as a high-growth tech stock. But over time, that consistency can deliver strong returns. Now, let's bring this into a practical framework. If you think about these three companies together, you can almost think of them as different engines within a portfolio. 𝗗𝗧 is your asymmetric opportunity. Higher risk, but with the potential for significant upside. NVIDIA is your growth engine. A company benefiting from a major structural trend. Ferrari is your stabilizer. A company that provides steady compounding through strong fundamentals. And this is something I want you to really understand. You do not need to find one perfect stock. You need to build a combination of businesses that can perform under different conditions. Now here is another layer that I want to add. All three of these companies have something in common. They have control. 𝗗𝗧 is building control over the customer experience. NVIDIA has control over critical infrastructure. Ferrari has control over its brand and supply. And control is what creates long-term value. Because when a company has control, it is less dependent on external factors. It can influence its own outcomes. And that is what allows it to compound over time. Now let's talk about mindset. Because this is where everything really shifts. If you are thinking short-term, you will always find reasons not to invest. Valuations will look high. Risks will look significant. Market conditions will look uncertain. But if you are thinking long-term, the question changes. It becomes less about timing and more about quality. It becomes less about price and more about business strength. And that is where the real opportunity is. Now let me ask you something. If you could only hold one of these three companies for the next 10 years, which one would you choose? Would you go with 𝗗𝗧 and its turnaround potential? Would you choose NVIDIA and its dominance in AI infrastructure? Or would you choose Ferrari and its consistent compounding through brand power? Let me know in the comments. Because this is the type of question that forces you to think like a long-term investor. Now, before we wrap up, I want to share something with you. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. At the end of the day, investing is not about chasing what is popular. It is about identifying what is durable. It is about finding businesses that can grow, adapt, and maintain their advantages over time. And the three companies we covered today each represent a different path to that kind of durability. 𝗗𝗧 through transformation, NVIDIA through infrastructure and innovation, Ferrari through brand and pricing power. Three different strategies. One common outcome, long-term value creation. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.